All right, we're live.
So I want to welcome everybody to our presentation today from IDX regarding cryptocurrencies and other digital assets. We're going to give a number of our participants an opportunity to get a couple more minutes here to log in. I see several folks are dialing in now. So if you can just give us about another 60 to 90 seconds to give people a chance to log in, and then we'll get started. I'll make a brief introduction to IDX and to Ben McMillan, and then we'll kind of take it from there. So thank you everybody for participating. Okay. Well, in an effort to try and be thoughtful about everybody's time today, I'm going to go ahead and introduce Ben McMillan. Ben is one of the senior leaders and founders of IDX. Their headquarters are in Scottsdale, Arizona, and we've been lucky enough here at Keybridge Compliance to work with Ben and Ben Jacobson and Andrew Swan and others there at IDX for many years, and really enjoyed watching them grow and have a number of successful offerings. But one thing that they have a significant amount of experience in is digital assets and cryptocurrency. Knowing our group of wealth managers that Keybridge provides services to, we've gotten a lot of questions on that very point. And I thought it would be helpful to everybody, both to IDX and to our collective wealth management clients to have this conversation today. So Ben McMillan, I'm gonna hand it over to you and let you kind of get us started, and hopefully I can go back and forth with you some questions.
Absolutely, thanks, Matt. So the most common question, it can just flow from here, but, just to take a 3,000 step foot back, what is a Bitcoin? What is all the hype about? We all know Bitcoin as a form of digital currency that's decentralized and permissionless. And I'll explain what exactly that means and why that's important a bit later. But really the primary utility was a way to send digital cash, quote unquote, securely between two parties that importantly don't know each other without the use of a financial intermediary, like a bank or an escrow agent or something like that. And so, the question is, well, how is that possible? And that was really the genius of the original Satoshi white paper. If you Google Bitcoin, this white paper will pop right up to the top. And it was launched over a decade ago, and it really detailed a way in which a decentralized network of computers could collectively verify transactions between participants in the same way that kind of recreated the verification function of something like a bank or an escrow agent, or really any trusted intermediary. If you go back to the days of ancient Mesopotamia, when there were lending markets, the primary function was that there was a trusted intermediary that could act as a facilitator between buyer and lender. So the Satoshi white paper, what it did, and the reason it caused such a stir among the computer science and the academic community, was it talked about how you could programmatically replace that consensus function, that trusted intermediary, with just code across decentralized computers. And the reason, what was really interesting about the white paper in particular, was that it actually referenced the 2008 financial crisis as a driving factor for the need for this type of decentralized payment function. Specifically the fact that it couldn't be, quote unquote, printed away if many people remember back in 2008, quantitative easing, which largely up until that point had been, very much kind of an academic exercise that nobody really thought would come to fruition in the way and the size that it did. That sent a lot of shockwaves across investors, kind of, worried about the continued durability of the US dollar if we're just going to be printing money like this. We saw that again more recently in March of last year, when Paul Tudor Jones kind of famously quipped in his investor newsletter, roughly 1/3 of all US dollars in existence were printed this year. That was one of the original appeals of Bitcoin, not only as a way to facilitate payments in this kind of novel way, but also as a store of value. So anyway, that's don't want to get too much, into the technical weeds there, but it is helpful, I think, to kind of level set, what exactly is a Bitcoin and why was it such a novelty among kind of the academic and the computer science crowd a decade ago versus just, something to be speculated on.
So Ben, to that point, relative, for example, to a traditional store of value like gold, what other positive attributes does Bitcoin hold?
So that's an excellent question. So this is a good chart that I like to show because it does, gold is kind of the natural comparison for Bitcoin. In fact, people refer to it as a digital version of gold. And again, that's based on their combined appeal that nobody can print it. You can't print more gold, as the saying goes. The same thing is true with Bitcoin. The original code specifies that there will only ever be 21 million Bitcoin in existence. And it's that scarcity, which was the original appeal for a lot of early adopters. One thing that's interesting is, we've been along in the crypto industry long enough to appreciate back in 2010, 2011, 2012, a lot of the early users, the vast majority were, people from mainland China, people from Latin America, specifically Venezuela. Venezuela had an extremely robust crypto community 10 years ago. And it's because if you look at that, Bitcoin very elegantly solved problems that they were facing, that weren't really an issue for us in America. If you look at hyperinflation, if you look at corruption, if you look at currency controls, those are very real world problems for, Chinese nationals, for Venezuelans, and several other smaller countries. And so that was kind of a perfect case study in the power of digital assets and just kind of helping solve these real world problems. And so if you look down this list, a couple of things I want to hit, everything I just spoke about is because it's decentralized, because it's scarce. There's a predictable supply that can't be tinkered with or manipulated by any central authority. It's also very portable. If you followed kind of the early community, you hear people, talk about the fact that they could carry their life savings, on a USB key across borders in a way that you just can't do with gold or even fiat US dollars. I actually worked with when I was at VanEck Global as the head of quant there, and one of the teams I worked with very closely actually still runs a very large Latin American debt fund, local denominated currency debt fund. And he said, we were talking about this, and he goes, in Venezuela, there's a very robust black market for physical US dollars. He goes, a lot of people don't realize that, a lot of commerce that takes place is actually in physical US dollars. And I asked him I'd read an article about a Bitcoin ATM. And he goes, that's becoming very appealing very quickly because just simply it's easier for people to transact digitally as opposed to having to worry about, these little squares of paper or linen more specifically. So anyway, Bitcoin really pretty early on demonstrated an ability to kind of solve a lot of real world problems that, again, now fast forwarding to 2020, we're starting to see kind of creep into the global zeitgeist as it relates to things like, inflation concerns, et cetera.
So Ben, one of the things, and again, appreciate the fact that many of the people that are on today may have some familiarity with Bitcoin, but how would Bitcoin, for example, differ from another type of cryptocurrency like Ethereum or things of that nature?
Yeah, so what's been interesting, let's see, I think here we go. What's been interesting about kind of the evolution of digital assets was, again, Bitcoin was out early. But what was interesting about Bitcoin was it was really optimized to solve that one problem that I discussed. The facilitating payments between, two anonymous parties that don't know each other in a decentralized way. But that was it. And so, Ethereum came a few years after Bitcoin, 2015, and it was designed to facilitate a much broader ecosystem of actual applications, software programs. And specifically the way it does that is through its ability to actually store and execute code on its blockchain. So this is known as smart contracts. And I've actually got a slide about this later. But at the highest level, that's really the big distinction between Bitcoin and Ethereum is really in what they're designed to do. And so, Bitcoin originally was to solve just purely payments in a decentralized way, whereas Ethereum had much kind of broader ambitions to really be something akin to an internet backbone, and being able to deliver, any number of decentralized applications that could just be running 24/7 on a blockchain. On one of the previous slides, one of the things I didn't mention that is a big appeal about Bitcoin is the fact that it's decentralized doesn't just mean that it's incorruptible or immutable. No central authority can just take it over. But also that it's more durable in terms of uptime. It's much more harder for the servers to crash globally, versus, even huge apps like what we have today, Facebook, and things like that still go down. And so, one of the things we've seen demonstrated as a very real world utility is just on the technological layer. That's one of the reasons, actually, that previous slide, a lot of people refer to Bitcoin or blockchain technology as a revolutionary technology similar to the internet, because that's actually the way to think about it. It's not necessarily that this is just a thing that can be speculated on because it's, kind of an interesting programmatic parlor trick, but rather to think of, we encourage people to think about this much more like the internet, back in the early 90s, where, I'm old enough to remember back then, a lot of people actually thought the internet was kind of a fad, or it was, never going to move beyond, online bulletin boards, or even things like emails weren't going to be durable. And now, of course, looking back decades later, it touches every part of our lives. And blockchain technology is very much going to progress, or is progressing in the same fashion. So at any rate, back to your original point, that's a key distinction between, Bitcoin and Ethereum, which then kind of ushered in a bunch of other blockchains, is this ability to facilitate to actually deploy contracts in a decentralized way, as opposed to just facilitating payments in a decentralized way.
When you speak to that, and we talk about the impact of technology, using that internet as an analogy, security is obviously a huge point of interest here. And so, can Bitcoin be hacked? Is that something that's of concern?
Yeah, so that's usually the kind of the top question, on everybody's mind before they actually pull the trigger and, buy a Bitcoin is, all right, how do I know that I'm not going to get scammed or hacked? And so, digital assets world is certainly no stranger to hacks. But what I want to caution here is it's important to kind of define that and distinguish somebody's account getting hacked versus the actual blockchain getting hacked. And so there's really kind of three primary attack vectors, quote unquote, as the cybersecurity community calls it, in order of most common. And the first one is just phishing. So this is the same as any other internet transaction. It's just that crypto is less so these days, but several years ago, it was still very much the Wild West. And so phishing attacks were just very common. You would set up an account, either a wallet, on an exchange or something like that. And it was just generally easier for people to either hack those exchanges or, just capture, set up fake pages, designed to capture people's login credentials. And so just like, phishing attacks were common in the early days of online banking, in the early days of crypto, it was no different. But again, that's a standard kind of, internet phishing attack. That's not something that's unique to the blockchain, other than the fact that, it's in the early days of technology, we kind of always see phishing attacks. The next one is, one thing that is unique to the blockchain that makes it both extremely powerful, but a little bit more tricky, is that, the idea that it's self-custodial. So that was another point that was on that earlier slide, one of the features of blockchains. And what's nice about, when I said permissionless earlier, what's nice about that is you don't have to set up any user accounts. And a lot of people, when they hear that, the immediate thing they think is, okay, that facilitates hacking and anonymous criminals and kind of drug money going back and forth. And that's not really the case. Bitcoin is not transparent enough such that criminals can get away with it. So when I say permissionless, the reason that's appealing is really just more a function of efficiency. If you have a wallet, if you can interact with the blockchain architecture, you're ready to go. All you need is an internet connection, and a wallet, a means for interacting with the blockchain. And you can send money on the Ethereum blockchain. You can start to participate in these different applications. So you don't need to set up accounts everywhere. It really fosters an extremely high degree of efficiency as a user, but also collaboration within the ecosystem. Now, what that means, however, is that you are your own custodian. So you have to really lock down your private key. So if you think about it as, your email account, your Bitcoin address or your public key is just your email address that everybody can see. That's how people interact with you. Your private key is like your password. The difference is most people don't have, money floating around in their email account. And so, you still continue to see some, hacks on forums and things like that, where people might be posing as, support from an exchange, and they say, okay, we can reset your account, but we need your private keys. So again, that's not the blockchain getting hacked. That's really just a variation of a phishing attack where, people let the private keys out of their hands. You also heard in the early days of people losing their private keys. You can Google, there was a case or a story a couple of years ago about, I think, a guy in Scandinavia that lost his USB key that had his private key and, something like 40 million Bitcoin on it. And, in a self-custodial environment, there's no support email where you can go and have your password reset. And so a lot of people learned the hard way that, okay, managing the private keys is something that takes a little bit of thought. Now, of course, fast forward to today, and there's a bunch of institutional solutions that solve for that. That's one of the things that, we help people do is how to, manage private keys in a way that is much more kind of standard in the custodial world. And the last one is something that's unique to blockchain, and this is the so-called 51% hack, a 51% attack. And so this is a theoretical vulnerability to any decentralized network. And, it's just simple math. If you decentralize the computers and somebody can take over 51% of those computers, then theoretically they can own the blockchain and they can start to reverse transactions. They can take Bitcoins, they can do things like that, or double spend Bitcoins, or any digital currency for that matter. And so, this is something that is unique to the blockchain universe, and it's an important concept in the idea of kind of minimum network viability. One of the big critiques of Bitcoin in the early days or in the early years was that when the number of nodes, when the number of computers participating in the actual network was smaller, a 51% hack was much more likely. Now we've gotten to the point, and this might be, when you start hearing kind of these different competing blockchains talk about how many nodes they're running, it's because they want to tout their durability that, it's more difficult to hack. One slide I like to show is, this was always a concern of ours as it relates to China. Up until very recently, China had 60%, roughly 60% of the nodes of the Bitcoin network within mainland China. Now, they weren't all controlled by a single entity, but this is the Communist Party, this is the CCP. They are no strangers to confiscating state assets. We would routinely tell people that there is a risk here that China, the CCP, could go and quietly at night start to nationalize these different big mining providers in an attempt to take over the Bitcoin network. Now, China, of course, went the other direction and banned mining. Because they have their own designs for their own central currency. It was a huge strategic folly of theirs, but they did it to the benefit. That was the single best thing they could have done for the value of Bitcoin, other than contributing some short-term volatility, is they actually just single-handedly took their control, their ability to theoretically, it still would have been very difficult, but their ability to theoretically control the network, and they just distributed it out across the world. So at any rate, that is kind of an interesting attack vector, and you have seen it happen on some of the smaller, newer coins. But the 51% attack now is really all but impossible on something as large as like a Bitcoin or an Ethereum, for that matter.
So Ben, you talked a couple of things. One, we looked earlier about how Bitcoin and cryptocurrencies would differ from a fiat currency, but in talking just there a moment ago about China, for example, potentially wanting their own digital currency. How could you have a digital currency that was offered by a state government, a central bank, and have Bitcoin side by side?
Yeah. So, and that's the big rush right now. I mean, the question always has been, it's interesting because, the early participants, the users of Bitcoin or blockchain love the utility. Central governments, including the United States, have always been wary of it because it's something that, they can't control. And so you've seen kind of an uptick in regulation, with China being the best example, just most recently outright declaring it illegal. But then also, central banks are going to figure out a way to participate. If they can't control it, they're not just going to sit by and try and tax it and let that be it. I mean, they're going to want to participate. And so the so-called stable coins, or central bank digital currencies is a huge area of focus right now. And so all that is, the stable coins are designed to be, digital proxies for the US dollar. So the biggest stable coin out there is Tether. And one Tether, represents $1. Now there's all kinds of questions around to, what is it backed by? And Tether in particular has been kind of plagued with scandals that, they're not fully collateralized, or they're the assets that are collateralizing their treasury are more speculative. You've got companies like Circle, which sponsors the USDC coin, which is more transparent, which is collateralized. And so central banks have started looking at that and correctly identifying stable coins as the easiest way for them to participate. Now that said, these are going to be centralized. They're not going to be decentralized stable coins, so the Fed coin or China coin, theoretically, or not theoretically, almost certainly they could toggle the supply up or down, as they wish. So it wouldn't be any more immune to inflation, than just normal fiat. What it would do, though, is it would make it much easier to participate in the Bitcoin ecosystem. It would provide a very important on-ramp, as they call it, because it is, in the early days, I remember back in 2010, 2011, I mean, it was difficult to turn fiat into Bitcoin. I mean, there was a very robust community on Craigslist where you would go and sit down in cafes and give somebody $100, and, they would sit there and transfer you a Bitcoin. And you'd kind of both be checking on your phones, making sure that the transaction settled. And then that's how you got a Bitcoin. And then of course, Coinbase kind of revolutionized the quote unquote fiat on-ramp capabilities in 2013 when they came around. But there's still a lot of people that aren't comfortable with it. So I think actually Fed stablecoins, have a place alongside currencies. There are important distinctions that, they're controlled by a central government. So again, it's a means for them to control, but there's also a utility there in terms of normalizing the interaction between fiat and digital assets.
So Ben, to that point, what's your gut reaction on the likelihood of us using Bitcoin or another digital currency as a peer-to-peer currency in the not too distant future?
Yeah, so that's an excellent question. And this is a really good timeline. So 2020 was kind of the year where a lot of this went from being, academic interest to kind of real world utility. And again, I was following Bitcoin with a high degree of interest 10 years ago. And it really wasn't up until even after Bitcoin went to $20,000 in 2017 and came back down, much of the utility it hadn't reached mass adoption yet. There were kind of two big factors that we saw really help kind of push the innovation across, over the Rubicon, as I like to say. One was just Ethereum and the smart contracts. Again, 2020, we just saw an explosion in the innovation in what could be done in the smart contract space. And it became clear that it is here to stay. It is the new internet. It is revolutionary. The programs, the applications that are being developed are solving real world problems, and they are not going away. Part and parcel with that was Bitcoin just starting to become accepted as an actual form of payment or a transaction of value. And I think, candidly, back to my original point, the original underpinning of the Satoshi white paper was concern about QE after 2008 and systemic risks after 2008. In March of 2020, we saw a huge uptick in the amount of fiscal and monetary stimulus worldwide. It wasn't just US, across the globe. And that really alarmed a lot of investors, or really just a lot of people. And again, back to that point, I love to quote that Paul Tudor Jones, I think it was in April of 2020, in his investor letter. He just called out kind of the stark magnitude of what we had just seen collectively, which was 30% of all US dollars had just been printed in the last couple of months. And so that's when we too, as asset managers in the space, started to see a huge uptick in interest from investors, really starting to say, all right, gold has always been our inflation hedge, or real assets has always been our inflation hedge. Bitcoin is now part of that bucket. But more importantly, or as importantly rather, when you start looking, so I mentioned all of that as the backdrop to, what we've seen even most recently. And you're starting to see big payment providers actually use blockchain to settle transactions, or to help facilitate transactions. So when you look at Square, PayPal, MasterCard, these touch every part of people's lives already. And so anything you can do to make it easier for people to use Bitcoin, the utility will start to become self-evident. And so again, on Square, on PayPal, Venmo, I think just launched as well. As soon as people can start using Bitcoin, I think we're going to start to see it very quickly spread across e-commerce in general. And then that's really when it's going to start to kind of become email, something that's ubiquitous in daily society. And that we're witnessing that. That's not in the distant future. That's not even in the near future. I mean, that's happening as we speak.
So you had mentioned, both in part of the discussion of this slide, but earlier in talking with Ethereum, for example, what is a smart contract? And I mean, what's an example of that?
So just very simply stated, smart contracts it's just code that is deployed on a decentralized blockchain as opposed to, a server somewhere. And so, some of the it's probably helpful to think about some of the early applications of smart contracts. And exchanges, crypto exchanges, not surprisingly, were kind of the first applications we saw deployed on Ethereum. So in the same way that you've got Coinbase, which is a centralized exchange, you go on there, you set up a user account, you deposit money, and then you can trade, Bitcoin for Ethereum, or any number of digital currencies. There are decentralized versions of that, where you can go and trade coins. And so the question is, well, how is that running, and who is running that? It's just code. So there's a smart contract, in its simplest iteration. There's a smart contract, or several smart contracts that are created by developers. Everything is transparent. So one thing I haven't spent a lot of time talking about, but is hugely important, is that the blockchain itself is entirely transparent. So Jamie Dimon quipped a couple of days ago, how do we know 21 million is the limit? Has anybody read that code? A lot of people have read that code. I've read that code. I have a GitHub repo from 2013 where I forked Bitcoin to, just kind of play around as a thought exercise. And I read all the code. It's in there. And that's a high degree of trust in the system. And so that's, one of the things about, smart contracts in general is that they are going to be transparent. And so everybody knows the rules of the game at all times, and they know that they can't be changed unless there's some conditional logic in the smart contract that can change it. So that's a very important point about blockchain technology in general. It's not just the decentralization, but the transparency that comes with that. And so that smart contract is stored on the blockchain. So, if you go back to the kind of the earlier point, what is the blockchain? It's just a decentralized group of computers that are providing that, what they call that consensus layer, that verification layer. And in exchange for that, by the way, they're rewarded with small pieces of each transaction in, whatever the unit of exchange is on that blockchain. So if it's on Bitcoin, if I'm running a Bitcoin miner, that's what you hear about when you hear about these Bitcoin miners. That's actually what they're doing. They're providing a very important function, which is verifying transactions on these ledgers, and then in exchange, they get a piece of the fee. Same thing on Ethereum. And so those smart contracts are stored on that blockchain, on all these decentralized computers. And so that's another appeal, is that they're what's known as being censorship resistance. And that's not censorship in the kind of First Amendment sense. It's in the anti-corruption sense. No one person, no governing authority can go and tweak those smart contracts. It is what it is. And it executes according to how it's programmed. So again, you can go on there, and I'll give you a very perfect example of why this is all important as it relates to exchanges. You know exactly what the terms are. You know exactly what you're going to pay. You know what the terms of engagement are, and you know that they can't be changed. A lot of the exchanges are actually, there's borrowing and lending apps where they facilitate, if I have Bitcoin or stable coins or Ethereum and I want to loan it to somebody, we can do that through a series of smart contracts, including what your required collateralization ratios are going to be, what your interest paid is going to be, what the schedule is. And it's actually, that's a very, back to the kind of my earlier example about ancient Mesopotamia, these borrowing and lending markets, along with exchanges, those are some of the early application use cases to pop up on the blockchain. And what was interesting is when, the question is, all right, that's good theoretically, but what happens in times of stress, real world events, in 2008, again, anybody that was in the asset management space in 2008, saw kind of, the predatory lending that was happening within the hedge fund world, not as it relates to hedge funds, but their brokers. These big banks could kind of unilaterally change the rules overnight and say, okay, you've got to post another, X% of margin, otherwise we're going to seize all your assets. And the rules of engagement were just changing from day to day. That's not the case when you look at these applications that are deployed on the blockchain. Like I said, the rules of engagement are A, immutable; they can't ever change unless a new smart contract is written, and B, it's fully transparent. And that's one of the reasons. Last example I'll give is in when China actually first declared that they were going to ban Bitcoin mining. The immediate reaction was a sharp sell-off in Bitcoin. And a lot of that was, not surprisingly, local Chinese sellers starting to liquidate positions to, in a defensive capacity to move them elsewhere. And what we saw was a lot of the centralized exchanges went down. If you look at things like Coinbase or Binance, two of the biggest, you couldn't access their websites. Meanwhile, if you go to those decentralized exchanges that I talked about, Uniswap is a good example, as one of the early big ones. It remained up. You could still transact. I knew that the rules of engagement were the same. There wasn't going to be any, uptick in transaction fees. I wasn't going to have to pay more than had already been pre-subscribed in the code. So anyway, that's a long-winded answer, but there's kind of a lot of important points I want to drive home, which is, the smart contract process itself is it's no different than just deploying code on a server, but it's the way it's done that makes it so powerful, as it relates to kind of the idea of decentralized, transparent applications.
That's super helpful. I think one of the things that I see as someone who has a very modest Coinbase account, but many of the folks on the phone, I would imagine, also see is the high level of volatility in some of the cryptocurrencies. And in fact, you see them drop percentage points in hours. Do you expect that to continue to be the case, or what do you expect there?
Yeah, the volatility in the digital assets world is not going away. Actually, I forgot to show this slide. This is a good one too. I'm not going to go through all these, but when you look at the real world use cases, there's a lot of interesting things that are already happening. So again, we still talk to people. The reason I like to show this slide is because we still talk to advisors today that say, how do I know it's not a Ponzi scheme? How do I know it's not going to zero? And we just say, look at the value that's already being transacted across, any number of different industries. Again, this is back to my point about it being analogous to the internet in the 90s. This is what's underlying not only the power of the smart contracts, but kind of the value of these blockchains going forward. Now, that said, your point, a lot of people say, as this becomes increasingly institutionalized, is the volatility going to come down? And the answer is absolutely not. And you've got a couple of things. First of all, I just like to show this chart because, Bitcoin is often compared to gold, as a form of store of value, as an inflation hedge. And, gold, it's worth mentioning, is not known for having an especially low volatility profile. But this chart shows just how much greater Bitcoin's vol is than gold. We're talking orders of magnitude. And so, for many of the same reasons that internet stocks for the first, 20 years, or even still, technology stocks are still volatile. Digital assets are volatile. There's a lot of speculation in that market. Again, this is, if anybody that thinks about, tech stocks back in the 90s, the dot-com bubble, there was a lot of utility there. That era brought us, Facebook and Amazon, but there was also, things like pets.com. And so, when you've got kind of a Wild West, highly speculative market like that, you're just going to get volatility. There's a lot of market participants. There's a well-known behavioral underpinning for this. It's called the lotto effect. People are just willing to overpay for, asymmetric return profiles. And you've got a lot of forward-looking growth too. That's heavily discounted. We're seeing that today. People are asking, well, how on earth is, Tesla sporting the market cap that it is? And, the only argument is such that there's so much future growth priced in. And so again, not dissimilar to technology stocks or internet stocks in the 90s, digital assets, you're seeing a lot of future growth priced in. And then, regulatory is a big issue. Up until very recently, digital assets have largely been kind of unregulated. And, as regulation comes, as we've seen this year with China, we saw it back in May of this year. We saw it more recently. There was a 50% drawdown back in May. There was a 20% plus drawdown more recently. That were entirely functions of the regulatory apparatus, in this case specifically China, starting to bring its forces to bear on digital assets. And so there's a lot of structural reasons that the volatility is here to stay, including the fact that actual supply is low. There's a lot of Bitcoin. Again, as quants, we love big data and we love blockchain because we have a Bitcoin node that we're running where every single day we're hitting every single wallet and getting all kinds of metadata so that we can understand who owns what. And that's, very instructive. You can see how many wallets hold, more than 100 Bitcoin and how active they are. And what we see now is that there's a lot of so-called whale wallets, which depending on how you define it is, 100 plus Bitcoin, where, they haven't moved in years. And so that's a lot of supply. That's analogous to, a stock with a large market cap, but a tiny float available to trade. And that's conducive to higher volatility. And again, that's something somewhat specific to digital assets, these large parts of the supply that are kind of locked away. Even I've got, a Bitcoin in a drive from 10 years ago that I would have to dig up to figure out how to move it. It's just sitting there. And so, as more participants come into the market, they're competing for, a fixed floating supply, which is, conducive to higher levels of volatility. And, we
to that point. If we expect volatility to stay, where do you see this ultimately fitting into an asset allocation model or into a client's portfolio?
That is the big question. And it's one where, we were always very cautious. We started seeing kind of early demand for Bitcoin, back in kind of 2018. And that's when you started kind of seeing, Wall Street's, what I'll call the kind of the evangelists on Wall Street start to tout, the benefit of 1% or 3% or 5% allocation to, digital assets and 60/40 portfolios. You started to see it, really hit a fever pitch in 2019 and 2020. And we were always very clear that, and again, this is another good chart to demonstrate it. The risk, the volatility of digital assets it's at a level that is theoretically a lot higher than many people are used to thinking through. And I always, when I talk to clients, I always show this chart. When you think about risk, it's not even just annualized standard deviation of prices or volatility. It's really drawdown. What's the money that can be lost at any one point in time? And when you get into this red zone, drawdowns north of 50%, the math starts to invert pretty quickly on you. And so what I mean by that is, I always go through this example. If you're down 5% in your portfolio, you basically need to be up a little bit more than 5% to get back to break even. Similarly for 10%, 25%, you still need to be up incrementally more, but it's within the realm of what investors have experienced, back in 2008, 2000. All of a sudden, when you're down 50%, you need to double your money just to get back to break even. And then God forbid you be down, more than that, which, by the way, as you saw in the previous chart, Bitcoin is no stranger to. You're down 90%, you need to make back several times your money, again, just to get back to break even. And, so this vector below the 50% line is something that really needs to be appreciated before investors, certainly fiduciaries, start to think about putting this in portfolios. And so that's, we've been very clear that, there's kind of a place for digital assets for many people. It's probably, not a fit for many people. And then it's also, how do you go about it? We have a lot of lessons from quantitative finance over the last, several decades about how to manage volatility. The managed futures industry in particular has done a very good job of kind of, delivering a best of breed insights in terms of how to do that. And so, we were very, very early in kind of trying to articulate to clients, like, let's think about, let's really understand what this level of drawdowns means, especially when you're talking about client capital. It's not just, if it's a high net worth individual or a family office that wants to take a flyer, that's fine. But, when you start talking about advisors or pensions or institutions, there's more homework that needs to be done. And so that's, we actually went through the exercise of kind of, leveraging the best of breed insights from quantitative finance. Again, we've got decades now of kind of, Nobel Prizes around the idea of, portfolio optimization and smart beta that are designed to help mitigate vol. Let's put that into a rules-based transparent index that seeks to do that. And the short answer is, momentum is a very effective way to kind of truncate those drawdowns. And again, that's why it's, you look at the managed futures industry, the CTAs, systematic global macro funds, all of them for decades have used, some version of momentum, not just simple trend following. It's not quite that simple, but, versions of momentum, not for return seeking, but for, risk mitigation. And the slide I like to show is, this simple scatter plot. I mean, the idea of really what you're trying to do, if you look at the monthly returns of that index that we were just looking at, which, by the way, is available on S&P's site. We encourage people to use it as a thought exercise. Download the returns, play with them, just understand what it how it behaves. But the idea here is that you can manufacture an asymmetric kind of call option type payoff profile, where specifically we're looking at monthly returns of Bitcoin along the x-axis, and then the risk managed index on the y-axis. And so you can see that, again, that kind of convex payoff profile where it's, it's still capturing some of the upside, but, the second momentum starts to stall, according to kind of a confluence of multiple types of indicators, risk is taken off the table. So the idea being that you don't have to endure all those drawdowns. This is actually what I want to show. You don't have to endure all those drawdowns to participate in the asset class. I like to show this chart too, because, we think about everything, not just digital assets. I mean, any asset class, and in terms of, compensated versus uncompensated environments. The best analogy I have is just counting cards at the blackjack table. You can go and just play perfect strategy and, basically break even, or you can leverage all of the available information and you can count cards in the deck. And there's a reason that casinos kick you out if you do that, is because it works. This is no different. Not all environments are created equal, particularly when you start to look at things like, Bitcoin, where, the volatility regimes can be segregated into, those in which you're likely to be compensated for underwriting that risk and those in which you're not. And so I always like to show this chart. And, the way I encourage people to think about it is the area between that blue line and that red line. So again, that blue line is just that risk managed index, which, by the way, doesn't use leverage, doesn't go short. So it's literally just modulating exposure to Bitcoin between 0 and 100% based on the risk environment. Long only Bitcoin is shown in red. That area you can think of as being the uncompensated risk premium. That's the risk that doesn't have a compelling or a positive return expectation with it. So it's return-free risk, as a lot of quants like to say about excessively speculative markets. And so this is especially important when you start getting into any asset class in which there's 50% plus drawdowns, is this idea that you really want to be judicious with where you place your bets. And so last thing I'll mention is that again, if you can worry about the downside, the upside will take care of itself. There's plenty of upside volatility in Bitcoin. You don't have to go seeking that. You'll get it. Focus on controlling the risk, and again, that allows the capital to compound more efficiently, to do so in a way in which, back to this slide, which is my favorite slide, you're not worried about 50% drawdowns. You can have reasonable expectations of, drawdowns less than 50% or really even less than 40%. And so it's just, the idea is, take an exciting asset class with huge structural, long-term bullish thesis, that's probably going to remain very volatile. And let's see if we can just bring its volatility profile down into something much more manageable, like commodities, for example, as opposed to, digital assets.
Well, to that point, and I think this is from kind of a capstone question to our presentation. I want to thank you and the whole team at IDX for taking the time today. But, if a fiduciary or an allocator wanted to put assets in this space, what types of vehicles are even available for that?
So yeah, that's really kind of the question of the day, because we've seen a flurry of filings for Bitcoin ETF based on the Bitcoin futures, importantly. So there's really there's two main ways. So the one is just spot Bitcoin exposure, and you can do that through really has to be private placements. So we have a couple of private placements that buy and sell spot Bitcoin according to that index methodology. What we're seeing now, those have traditional private placements. They're not not everybody can qualify. There's a 1-year lockup period. They can trade 24/7, and we do trade 24/7. So there's an appeal there, particularly because there is non-trivial amounts of activity on the weekend and during the Asia sessions. To put numbers on it, you can see on this chart, back in May, we were able to get out of the way of that 50% drawdown, several weeks ahead of the China news. And again, you started seeing some tremors in the market that, we started seeing the vol regime go from, what we classify as very favorable to unfavorable very quickly. But then also more recently, just a couple of weeks ago, we were able to trade over the weekends, ahead of some news coming out on Monday that, there was a real utility there for that weekend trading. That can only be done in spot Bitcoin, and that can generally only be held in private placement trusts. And there's a handful of them out there, including ours. The Bitcoin ETFs are all going to be, or the Bitcoin 40X are all going to be futures based. And that was based on guidance from the SEC that really placed a high degree of concern over the custody issues around spot Bitcoin, because it is tricky, and a lot of people are uncomfortable with it. It's just a trickier thing to get your mind around. So the fact that the CME Bitcoin futures are traded on, the CME, they're cash settled. The SEC came out with guidance declaring that those would be acceptable within a 40X structure. And so we saw a rush of ETFs file, and it looks like the first one of those, the ProShares, will go live tomorrow. But that's another one too, where we caution investors, you've got to be, we're comfortable. We run mutual funds, we've run ETFs in our past lives and our past jobs. ETFs, have been a very good force for investors in general. The big utility of ETFs have been, largely from a tax advantage side, as well as from providing intraday liquidity. The flip side has been, particularly in the QE environment, most recently, we've seen, the fact that ETFs are forced buyers can actually add to the market distortion. And there's, without naming names, there's very large, very well-known, very popular ETFs that have raised tons of money this year. And, there's been all kinds of questions as to, how on earth are they going to deploy, the $30 billion that they took in last week, in a way that protects existing investors. Those are, we have those same concerns as it relates to Bitcoin ETFs, which is why, to answer your question directly, we chose to register a mutual fund that will hold the futures. First of all, the idea being, if our algorithm is managing the net exposure on behalf of investors, the intraday liquidity is less important. That's being taken, care of on behalf of the investors. So by not being forced to be indiscriminate buyers at any point in the day, having a little bit of leniency to kind of, tactically deploy capital, in a way that protects existing investors is hugely appealing. And then also the ability to cap AUM. I would not want to be running a Bitcoin ETF where, I might be forced to deploy billions of dollars in any given day. Certainly not in a static long only strategy. I mean, you're almost certainly contributing to, to quote Corey Hofstein at Newfound Research, so-called liquidity cascades. So, ironically, a lot of AUM in those products is, probably going to contribute to volatility and, therefore actually be conducive to a strategy like ours. But it is something to be aware of from an implementation perspective, is that futures are a little bit trickier. Last thing I'll say on that too is the fact that they're futures, you have roll costs, which in the scheme of things aren't huge as it relates to other markets, but it's on the order of 10% a year by our estimates. And so again, by not being in the market when you don't need to be, that 50% of the time that's quote unquote uncompensated, you can just avoid, not only unnecessary volatility or uncompensated volatility, but just, paying a tax for that vol too. So anyway, it's the options in the marketplace are, kind of spot Bitcoin exposures, and that can be done, directly through, individual Coinbase accounts like you and I have, through private placement trusts like what we have, as well as a couple other providers. And then, the kind of the more exciting topic is these mutual fund and ETF registrations that are coming to market imminently. Which ultimately are good, because I'll end by saying I do think in this state of the world, I'm kind of in the Paul Tudor Jones camp that inflation, this level of money printing cannot be ignored. We're starting to see it manifest in upside surprise expectations as it relates to inflations. I actually do think digital assets when prudently done, is a compelling, part of that defense, alongside other things like real assets and gold. But again, the caveat being just, really be mindful of how you approach the asset class from a statistical perspective, versus as well as how you approach that asset class from an implementation perspective. So.
Well, Ben, first of all, I want to thank you for taking the time to meet with us today. And we really thank all of our attendees for joining us. My colleague Kaylee Mitz and I are going to be working with Ben and the team at IDX to circulate a recording of this session as well as the deck to the group that attended, but also to other managers that work with KeyBridge. And so if anybody on the phone has any questions for Ben, and his contact information will be available, but please feel free to come back to me as well. And Ben, thank you to you and the team, and wish you the best of luck with everything you guys are doing.
Thanks, Matt.
All right. Thank you, everybody. Have a wonderful night. Take care. Bye-bye.